Okay, thank you all very much for joining us this morning. My name is Steve McMenamin, and I'd like to welcome you to today's event, which is part of the continuing series of the Greenwich Roundtable. Our topic this morning, Quantitative Insights and the Monetization of Big Data, is a continuation of a session we held 20 years ago today in this room called Mathematics, Common Sense, and Good Luck with Jim Simons. No pressure, fellows. Today, the world's changed in so much as there's more and better data, and we're here to learn how we can make money from this phenomena. Our speakers are amazingly smart and thoroughly different from one another, and I'll briefly introduce them after I say this. The speakers' views are their own and don't necessarily represent the views of the Roundtable, its staff, or the trustees. Having gotten that out of the way, I'll introduce the speakers alphabetically, starting with Braxton, and Braxton will be speaking first. Braxton McKee is the chief executive of Euphora, a software company he founded in 2010 in New York that helps companies deploy data science at scale. Euphora provides, at scale. Boy, I need bigger font here. Euphora provides data science and engineering consulting as well as enterprise support for P4A, an open-source software platform that makes it dramatically easier to run statistical analysis on massive data sets. Euphora has venture funding from Two Sigma Ventures, Contour Venture Partners, and others. Before Euphora, Braxton led credit modeling at Ellington Capital Management. He's a domain expert on data warehousing, distributed systems, parallel and functional programming, and machine learning optimization. Next is Ryan LaFond. Ryan is the head of research for the Asia Pacific and Emerging Markets Equity Group inside BlackRock's Scientific Active Equity Team, or their Skunk Works, as he used to call these groups in the old days. Dr. LaFond came to BlackRock through a merger with Barclays Global Investors in 2009. Before that, he was head of research at Asia at BGI. Before BGI, he was stationed at Algert Cold Iron Investors, and he started his career as an assistant professor at MIT's Sloan School of Management. Sitting next to Ryan, Rashid Sabar is the head of quantitative strategies at Ellington Management Group and a founding member of Ellington's Systematic Investing Group. Over a number of years, he developed the core set of strategies traded by the group, including algorithms in stocks, financial futures, commodities, and volatility. Over time, Rashid has grown the number of strategies traded by the fund and has cultivated a team of exceptional researchers and traders. Today, he oversees Ellington's systematic investment business and is responsible for setting and directing the group's research agenda and trading activities, respectively. As a student at Harvard, Rashid authored and published 4 papers in the mathematical field of combinatorics, which, according to Webster's, is the branch of mathematics dealing with the combinations of objects belonging to a finite set in accordance with certain constraints, such as those of graph theory.
Hold on, Steve.
Oh. Wow, Steve's the man. And finally, Brian Furtado is the moderator of the Greenwich Roundtable and organizer of today's session. Brian runs the private investor practice, the family office group at BlackRock. He's also a trustee of the Roundtable and a long-serving member of our programming committee. Please welcome Brian as he sets us up for today's discussion.
Terrific. Well, thanks, Steve, and good morning to everybody. I'm really excited to be here on this topic today because I personally just find it absolutely fascinating. And Steve mentioned Jim Simons coming here 20 years ago. So I think, I just want you all to consider this staggering fact. So Jim was here 20 years ago, and if you think about just the amount of data that's been created in the history of mankind, 90% of the data that's ever been created was created in just the last 2 years. So just think about that, 20 years, the last 2 years, 90% of the world's data. So combine that fact with just the massive changes that are going on in the trading ecosystem. You think about the explosion of ETF exposure trading, high-frequency trading, And just the sheer number of market venues now that are out there, it's changing the landscape dramatically. So if you take those and then just take it to a micro point of just in the last 60 seconds that Steve and I have been chatting here, how much data has been created, it's absolutely staggering just in that short space of time. And I think our panelists will probably get into that. And there's some fascinating, if we had the charts here, and we don't do that here, but we could show you just the power of that and just what's going on. So it's really an incredible amount of data that's been created. And I think it's easy to see why data science in general is just becoming such a massively important topic for investing, and how finding a clear signal in the noise and all that data can lead to alpha opportunities. And so, but it's also just as easy to see, I think, how we could all drown in this data. So there is a lot of noise out there, and I'm just really pleased that we had this great panel here today to help us think through and think about how do we find signals in the data. So with that, we wanted to start with Braxton, because Braxton's firm, as Steve said, is a growing business that provides data science technology to investors that are really trying to adopt this as a part of their business. And so I think he has a very good macro view of what's going on. Braxton, why don't you kick us off and give us a kind of an overall picture of what you're seeing?
Yeah, absolutely. So let me make sure I speak into the microphone here. So, from where I sit, I'm a bit of an outsider in some of these funds. I came out of the hedge fund industry, but I'm usually inside of a firm there to help them upgrade their engineering and their data science process. And from my vantage point, the chief difficulty is that a lot of these funds don't have engineering as a core competency, as a core discipline. And of course, if you're hearing this story about how data volumes are growing at this exponential rate, it's actually, from a technology perspective, quite a challenging problem. I look at the world and I kind of think of the internet as this giant real-time sensor that's collecting a huge amount of information about what's actually going on on the ground in the world. So we currently have the ability to get real-time data about what temperature it is on planet Earth. So if you're trading energy, that's incredibly important. We can know the GPS location of every oil tanker in the world. You can find out what any individual consumer thinks about pretty much every brand in real time from looking at social media. And this is primary source data, right? So if you think about people doing research to decide what stock they were going to buy 15 or 20 years ago, they would do some research, they would look at a report, maybe they would read some news articles, they'd see the results of some study that somebody else had done. They're largely making their decision based off of secondary information. But what's possible now is for each individual firm to actually collect the source data that's actually measuring directly what's going on in the economy, and then use that to actually make investment decisions. And so I guess what I would say, looking on the outside into these firms as I try and help them do this, is that the engineering skills required to actually do this are not present in most of the funds that I talk to. This is actually a serious problem. So if you look at a lot of places, the IT function historically has been there to help them build tools to support the operations of the business, right? So people will build, everybody has their own homegrown risk management system that they've built, and it's some screen that sits on the desktop of traders. And, if there was a bug in that system, people would actually notice it almost immediately. Maybe the thing would crash or some number would look wrong. And so, from an engineering perspective, the team that was building that infrastructure could get away with just putting new software out there and waiting for someone to notice that there was a problem and then fixing it. But when you actually have big data infrastructure that's taking hundreds of millions of data points and processing that into some derivative signal that it's putting on the desks of people who are then taking that signal and using it to make investment decisions, the consequences of failure isn't just that one of your traders is annoyed because the system that they live in is out for an hour. They're actually going to make a wrong trade because of it, or they're going to they're going to have serious
Rashid, let's turn to you. Let's talk about sort of making some money from all these signals. What's happening at Ellington, and how are you all making money from this?
Yeah. So, and I apologize. So instead of talking about Ellington directly, which I think will be, I'd rather give kind of food for thought for everyone. So I'm going to go a little bit off script here. I'm going to start with just a story that I think probably many of you have heard, but it's worth repeating, and that's the story of Google Translate. So a lot of us have used the software, the translation software that Google has built. There's this really fascinating paper by this guy, Peter Norvig, that's called The Unreasonable Effectiveness of Data. Very worth reading, or there's YouTube videos also where he's talking about it for an hour. It's easier to digest than the paper. And basically the takeaway is that prior to Google Translate, the paradigm for translation software was very much one about grammar and rules, and the team of people building the software for translation were primarily linguists. The approach that Peter Norvig and his team at Google took for translation was radically different, and a very data-driven approach as opposed to a rules-driven approach. So what they realized was that on the internet you have this enormous data set of documents that are appear in multiple languages. And you can kind of throw a substantial portion of the linguistics and the rules out of the window and just make it a purely statistical or data-driven exercise, correlating documents in one language with documents in another language and kind of discovering translation through data. What he outlines in this paper is this kind of curve of data utility, and it's kind of an S-shaped curve where when you don't have enough data, you can't do something like that. But then all of a sudden there comes a tipping point where there's enough data, and now you can be much more statistically oriented rather than theory oriented. And so the reason that I share this story is, one question I have that I think is worth thinking about, and I don't have an answer. I don't think anyone has an answer, but it's worth conceptualizing is, where are we on this data curve, right, in financial services, in quantitative marketing, et cetera. I think that that's very much worth conceptualizing. Now, the focus of the symposium, how do you make money off of the data? I think that a lot of people have it in mind that the people that are most well positioned to monetize big data are quantitative investors. As Braxton pointed out, they already have at least a culture of analyzing price data. Now you're getting these non-traditional data sources. Maybe it's just a matter of plugging that into the analytical machinery. And I think it's certainly true that quantitative processes are well positioned to benefit from this kind of data revolution. But let me offer a couple of additional thoughts. Right. One is that I actually think that over the next 2 to 5 years, the group of hedge funds or traders that are most well positioned to benefit from the data revolution are the fundamental players. Tiger Cubs and so on. And they're not in a position to benefit from it now for a lot of the reasons that Braxton mentioned, that there just isn't a culture of technology. There isn't, you can't analyze these big data sets in spreadsheets, where traditional kind of fundamental analysis takes place. But you're starting to see kind of, forward-looking frontier fundamental shops add data scientists and add kind of data analytics capabilities. Probably the most famous example is the Alperion project with Point72, where they added something like a team of 30 data scientists to help kind of provide analytics for their fundamental traders. I've heard that particular operation is having some growing pains because at the very end of the day, the language that data scientists speak and the language that fundamental analysts speak is very different, and it's non-trivial to kind of solve that translation problem, if you will. So I think that, and even before I get to that, why do I think that the fundamental players are the most well-positioned to exploit it in an ideal world where you have this kind of collaboration between data analytic processes and fundamental analysis? Well, the reason is that some of the most interesting data sets, so for example, there's I'll give you two examples. One is you have a company out there that's kind of building browser plugins, and as a byproduct of these browser plugins, they're recording the URL history of a panel of something like 2 or 3 million U.S. Internet users. So every time you go on a web page, it's recording what web page you went on. That's a massive data set, and you can imagine its utility for looking at things like people going on Target.com and making purchases, right? The reason that's more that kind of a fundamental guy can extract more value from that than a quantitative guy is because ultimately the set of e-retailers that are publicly listed companies is a pretty small set. And for quantitative traders, you need kind of a large cross-section and a long history to kind of create a diversified portfolio. You don't take concentrated bets. So if you have a data set that has a short history or applies to a small set of names, it's actually a data set that's much better for a fundamental guy who has a lot of context on a particular name, and this additional data point, helps complete the mosaic, and you can take a really concentrated bet on it. They're in a really great position to exploit that data set were it not for the lack of capability, right, or lack of DNA. That's one example data set. Another kind of data set is, kind of credit card data. You have, or purchase data. You have startup companies that are creating software to kind of extract, help you manage your e-purchases. So they go in and they parse your emails, and they extract your Amazon.com purchases so you can basically see where you're spending money. As a byproduct of that, they kind of know what you've purchased when, and they go and they sell that data set to financial services companies. Again, something that's useful for a quantitative process, but hard to really make a big bet on it because it applies to a small set of companies for a small history. That's one thought that I would offer the audience, that over the next 2 to 5 years, who's going to seize the opportunity to create kind of hedge fund 2.0, where you really are marrying the, quantitative processes and data analytic processes with fundamental processes. The second thought that I'd offer the crowd is, we talk about stock-specific signals, right? I've talked about credit card data. I've talked about user browser history and so on. One place where big data, doesn't get talked about at all is in macro investing. And if you think about quantitative macro players, CTAs, I mean, they epitomize exactly what Braxton was talking about, which is price, volume, open interest as your only inputs, and almost a religion that price contains all the information that's available. And while it's true that some of the most kind of obvious data sets, social media, et cetera, relate to specific stocks or specific products, I think that there's room to be a little bit creative and take some of these data sets and apply them for a quantitative macro process. So, for example, one of the data sets that I find most interesting is a data set called LinkUp, where it's a company that basically has created all these web crawlers. So suppose I'm a company, and typically if I'm a company, I'll have a web page. And if I have a web page, I'll typically have a careers page. And on that careers page, I'll have the jobs that are open for my company. This company, LinkUp, has built software to go to all these companies and parse out, extract the information from their careers page to see how many jobs they have open. Of course, you can think of stock-specific signals where that would be useful, where if you look in a particular industry, you have one company that's hiring and another company that's not. Probably their sales prospects and their profitability prospects are different. You can trade that. But also having this real-time data set of company job postings, historically, you can build things like a non-farm payroll predictor. Or you could build, housing numbers predictor by looking at it by zip code and the type of job being listed. The point being that I think that, within quantitative macro processes, which in my opinion are in extreme need of evolution, you don't really see people thinking about or talking about how data can apply there, because the assumption is that macro is macro. It's very slow moving. And yes, people talk about kind of nowcasting and real-time economics, but never really using these non-traditional data sources in some thoughtful aggregate way to drive differentiated macro insights. But I think that there's room for that, and I think that that's, again, a place where investors ought to be pushing their underlying fund managers to innovate. The third thought that I would offer the audience is that I've heard the question, how do I use data to make money in investing, asked many, many times. I've very rarely heard the flip question asked, which is, instead of how do I use data to invest, how do I invest in data? I think that there are very few things, big picture, where in today's world you can say it's only going one way, right? Maybe solar, right? But data is certainly one of those things. It's only going one way. And outside of narrowly using that data to trade publicly listed stocks or, futures instruments, macro instruments, there are plenty of other ways to make money off of this, secular trend, right? There's an entire, and let me just offer two examples. One is, and again, going back to the example of publicly listed companies, right now data is not kind of recognized as an asset on a balance sheet, right? Like if you think about a company like LinkedIn, what are they really, right? Is it, people analyze them in terms of their profitability and their revenue, et cetera. But if you conceive them instead as a data set of self-updating, resumes and a graph of relationships amongst those, maybe its valuation looks completely different. And maybe in 5 years or 10 years, the GAAP accounting rules will recognize data as a balance sheet asset. And maybe if you start thinking that way now, you get some differentiated insights into the value of companies. But again, even going beyond, company valuation, if you think about just the world and the data ecosystem that's evolving from the companies that are building sensors to measure the data to people who are, data providers who are selling data to, entrepreneurs who are building, software solutions to help people monetize data, people building security solutions, there's an entire data ecosystem out there. And I think that for people who have flexible mandates to kind of invest in more than just hedge funds and people who trade publicly listed stocks, private equity, venture capital, et cetera. It's a really exciting time for companies like that. I was recently asked to be an advisor to a company that is a recruiting 2.0 company, for example. So they are a company that's just kind of, it's a recruiting company, but they focus just on data scientists. And recruiting is another industry, by the way, that's in dire need of technological innovation and update, right? So this particular company, which I found fascinating, is not only focused on data scientists, but they're also using science in their matchmaking process. They have all their candidates take tests. They have they model employer preferences, and it's, I think, one of these really obvious companies that's poised to benefit from this huge secular tailwind in data.
Right. Thanks, Rashid. What about these volatile markets we're in right now? I think there's probably applications for big data and some of this there. I mean, we're all kind of figuring our way through that now. What are you seeing there?
I think that as Braxton said, the internet gives you a real-time pulse on the market. The conversation with kind of data in the markets, in my mind, is a little bit different. In terms of today's markets, I think that it's absolutely a trader's market. I would position kind of in your portfolio towards kind of risk on, risk off type strategies, more short-term oriented. If you look at, and I was telling a gentleman this earlier, right before the panel, if you look at, for every stock in the universe, you can look at its price, you can look at its earnings estimates 1 year out and 2 years out, just say consensus. And then you can use a DCF model to say what is the growth rate, long-term growth rate that rationalizes today's price, right, given those 1 year out and 2 years out earnings. So basically, you can get this concept of a market-implied long-term growth rate, and you can do that for every stock, and then you can kind of capitalization weight stocks and get it in aggregate. And you find that right now the market is basically pricing a 0% long-term growth rate in aggregate, which is probably too pessimistic. But it doesn't have to bottom out here. In 2008, it got to a market-implied growth rate of negative 4%. And we started at basically at plus 5%. So in terms of getting to a 2008 like bottom, if we assume that that's really the absolute bottom, we're something like halfway there. So big picture, I would, if I were a buy and hold investor, I would have dry powder, wait for something like a 20% correction year to date, we're 7-8% of the way there, and then it's a massive buying opportunity. Or act like a trader, a more tactical short-term, and kind of tilt your models and your portfolio towards shorter-term strategies and strategies that kind of actively modulate their net exposure.
Okay, thank you. Ryan, let's turn to you. You've been obviously focusing in a lot of different areas in this space. Impact investing is one area. I know you've thought about China, Greece before, and the applications of big data there. Just talk about some of the different areas where BlackRock is using big data.
I think if we step back a little bit and think about how we've approached big data in some sense, and I think first you have to understand very much like big data is very relative. What's big to us is not big to Google. But ultimately, when we think about big data, a lot of this is the fact that I think the way that I would say it is the key investment questions haven't really changed. How you go about actually answering them has. And a lot of that has to do with really how technology has changed our lives. And lots of times how technology has changed our lives resulted in data. The most interesting and popular one right now, because some of you might notice there's this like election going on, is Pandora. So when you think about Pandora, right, so it used to be you went home from work and basically you turned the radio on in your car and you listened to it. Now, the challenge is what's happened with Pandora is Pandora, right, it's an app, it's online music, so what do I do when I get in my car now? Put my phone on there, pop up Pandora app and start listening to music. It's the same activity I've done for 10 years, but now, because it's through an app, there's resulted in data. And it turns out that data is actually really, really useful. So anybody who's I know everyone is avid readers of like user agreements and things like this. Interesting about Pandora, not only do you get access to all your data, but if you put them on your phone, they get access to everything else you do on your phone too. So like Uber won't sell your data, but Pandora will sell you Uber's data. It's kind of interesting side note. But when you think about this result in data, right? What is actually Pandora, what is like your musical taste really useful for? Who you're going to vote for. Pandora sells that data to the various campaigns. Because, of course, if you listen to, like, country music, you typically vote more Republican. If you're listening to, rap, hip-hop, things like this, typically it's more of a Democratic. That actually tying that kind of your musical choice to you and that kind of resulting data is useful for decisions. And it's very much when we think about investments, it's no different. And so, Brian, you asked about the kind of, we think about, like, the macro situation and things like this. Well, of course, macro is actually pretty important. When we think about macro, and I'm just, in general, obsessed with everything I can do related to text, is, we basically look, and we've got this, what I would call, really wise crowd. And it comes in the form of basically 5,000 conference calls a quarter. Those 5,000 conference calls you get every quarter is basically 5,000 CFOs, CEOs talking about what they're seeing in their businesses. Now, what can you do with that? You can take those 5,000 conference calls and start looking for topics, looking for things like who's talking about recessions. So in a conference call, people, the CEOs, CFOs are giving you an outlook. And you can go say, is that outlook actually talking about slowing growth, recession, various things like this? One of the interesting features about that is that when you go and look at that, roughly only about, I think it was like 3 to 5% of the conference calls last quarter talked about recessions. And if you look at that relative to, say, like 2008 or 2009, there you basically had upwards of about 40 to almost 70% at various points of time talking about recessions or slowing growth. Now, what's interesting about that is when you think about kind of crowdsourcing a macro trend or figuring out kind of what really is going on the ground, you're able to take these 5,000 CFOs, CEOs, look at their comments, process them through using algorithms, and really put that together in such a way that it becomes pretty informative. To give you an example, when you think about the kind of change of the delta in CFOs mentioning recessions in their conference calls is actually a really, really good leading indicator. You know, it's like we would talk about, sometimes people talk about green shoots. You can talk about this from the standpoint of maybe, you know, dying green shoots to some extent because you've got them all out there. But I think that's just one example of really how answering some of these questions has changed. You think about other examples of, you know, look, when we think about big data, for us, it's basically search data, textual data, various kind of machine learning, and social media is the way that we kind of divide the world up. To give you an example, when you think about, you know, something like answering a question about like the future fundamentals of a business. If you wanted to forecast the future fundamentals of, say, a consumer firm, something like Walmart, 5-10 years ago, what might have you done? You would go out and you would look at something like same-store sales and maybe new store openings, things like this. How do we do it now? Search data and beacons. Search data is great because you can go figure out how many people are actually going to, you know, like Walmart.com. Are they doing secure click-throughs, things like that? How is that changing day over day, hour over hour, minute over minute, quarter over quarter, all that wonderful stuff? Is everybody familiar with beacons? You know what a beacon is? So everybody has a cell phone. So basically a beacon is just a piece of hardware that sits on top of a Wi-Fi network. Every time, you know, you go to your phone and it's asking, do you want to join this Wi-Fi network? If there's a beacon on that Wi-Fi network is collecting a little information about you. Sometimes more, sometimes less. Now, what's interesting about this when you think about a beacon, what are they actually really useful for? Well, they sit on lots of, you know, stores' Wi-Fi networks. So you can, you know, basically see literally in real time how many people are going into that store, how long are they spending in that store. All of this turns out is really predictive of what the sales are going to be. And so again, when you think about forecasting the, say, like the future fundamentals of a business like that, it's much more how you go about doing that now has changed. So instead of same-store sales, it's search and beacons. You think about something like, you know, corporate culture or management quality. Anybody who, you know, who's investing in firms and not using Glassdoor, it's a great way to figure out about corporate culture. Vokers is the Japanese equivalent. What is this? They're websites where employees are essentially posting reviews about firms. And everyone first, when you hear that, if you're not really familiar, you're worried that this is just like a website where somebody who just got fired is going to be, you know, essentially ranting. It's really not. There's a lot of really self-policing out there. So when you go look at something like Glassdoor, if people or the employees are actually really quite happy and it's a good corporate culture, people kind of defend it. Somebody posts something bad, they'll rebut that very quickly. Somebody posts, you know, about a firm that's truly good. If the firm culture is really bad and somebody posts something really bad, it tends to, you know, it's like gas on a fire. It explodes. But you want to think about something like this is how might you understand corporate culture, let's say, 10 years ago? Well, maybe you'd have to go and meet the management team. How do we do it now? Social media. Other things we think about, like management quality. I lots of, you know, say it's so important to invest in kind of high-quality firms. Well, how do, you know, what have we been doing a lot with this? A lot of data and textual information. What's really interesting about most developed markets, essentially when you go and look at it, you know, typically when an event happens at a firm, you get both a press release and a regulatory filing. The interesting thing about the press release is it's written essentially by like the IR department, things like this. Maybe it's got a PR firm. The regulatory filing tends to be written by like the lawyers or other people. One goes to the regulator, one goes out there to investors. Now, I mean, I think within SAE, we're skeptical people to begin with, but you know, our somewhat simplistic view is that if the events are good, you want to get them out there in a very kind of clear and transparent fashion to everybody, to both, you know, regulators and investors. Maybe if, you know, again, things are a little bit bad, things like you want to put a little spin on it. Now, what's interesting about this, when you think about trying to understand like management quality, well, what has lots of kind of new algorithms and things allowed you to do? We can take two documents and very easily compare the words used in those documents. So when we think about management quality, it's essentially looking and say, are the words in your press release describing an event the same as the words that you're using in your regulatory file? You find lots of situations where they're not. In fact, like some of the worst firms, you find these wonderful things where like the press release is like wonderful and positive, and the regulatory filing is very negative. Like that's never a good thing. But that's kind of how we understand, you know, when we think about using big data and tools to understand issues related to like management quality. We've got lots of fun examples too of which firms they throw up in different events. Typically, you know, you think about an insight like that, lots of times when you have, you know, departures, the press release is very interesting, I wish you well, and all these wonderful things. The regulatory filing says a lot more about what actually happened. When there's that spin feature, that's never really quite good. And maybe like another couple examples, when we think about this in terms of making money, China is one of my personal favorite kind of areas. For a long time, if anybody knows who's invested in the A-share market there in China, what's one of the big challenges with it? It's dominated by retail investors. So about 70-80% of the volume in China is basically retail. Asia in general tends to be one of the only markets where investors still pick stocks. Most other markets, a fun fact, and Brian kind of alluded to this at the beginning, last year was the first year in the U.S. where more capital was traded on ETFs than single stocks. That's a big dramatic shift. Asia, they still pick stocks. China, it's still retail. But when you think about something like this, and you say, okay, in the A-share market there, it's really difficult to understand what's on the mind of 1 billion Chinese. The good thing is they love social media. They love the level of and activity of posting on various kind of blogs and things like that is ridiculous. Now, so if you want to capture really what's on the mind of, say, 1 billion Chinese, you can now do it with social media because that communication channel that you used to have this conversation, let's say, with your friend or whatever, now it happens online and that's captured. So what do you have to do? Well, the first couple of things you have to do, we target and scrape literally millions of blogs a day. It's getting even bigger. One of the first things you notice, though, is that, let's say, how people talk in kind of professional communication is a little bit different than how they actually talk on blogs. So you need a different dictionary, right? I mean, that kind of makes sense. You don't see the term liar show up a lot in, like, sell-side reports. On blogs, it's a little bit more popular. Of course, if the blog's talking about liar, that's never really good for the stock price. But so, again, when we think about big data, all this, it's not that we didn't know that retail investor sentiment in China was an important feature. It's that you couldn't capture it before. And so many of these things we think about big data, it is very much in that is that lots of ways when you can harness these tools, when you have the correct technology. We benefit tremendously by being based in San Francisco, in that it opens up a whole new world. It's a world where, whether it's quants, whether it's one of us, it was funny, like Rashid was talking about linked up jobs. We can talk a lot about that data later. But it's great when you can actually look and say, look, using job postings for macro actually is a really pretty good predictor. Using and taking that and putting it in even more interesting to think of features where you look and now I know basically location. Every post comes out, where would this job be located? Well, we know, are you going to hire people in New York? Are you going to hire people in, say, San Francisco? Are you going to hire people in Michigan? You can also figure out which firms are exposed to those states. And so there's some fantastic nuances of getting these more timely macro indicators combined with various different measures of exposures here. That actually turns out to be fairly kind of fruitful. I guess the final note I'd leave you with, and this is more about like, and Brian's kind of talking about this a lot, I love to play this fantastic game with my wife, which is called like, who knows me better, her or Google? Go with Google. Literally go with Google. And if you needed the proof point on that, first off, remember, like, Google sees what you do when she's not looking. But the other thing was an interesting proof point is a study came out of Facebook. So essentially what they did at Facebook is they built an algorithm based on Facebook likes to predict personality. And then what they went and said, they compared basically your friends, your coworkers, your family, your spouses, assessments of your personality, and that done by the algorithm. Now, the good thing is, like, the correlation between your personality traits and, like, your coworkers is about 30%. So they do know you. The good thing is spouses came in, and I think it was like 56%. The bad thing was the algorithm came in at 56. Now, if you think about this in terms of why, right? What are Facebook likes? It's revealing lots of features about you. It used to be that you had a picture book that you put up on the wall or something like this around, you flip through, and what you saved in there probably told you a lot about what you valued, what you like to do. Now people do that online. And that's resulting, when you do that online, you put likes in there and you put information, it results in data. And that information is useful for lots of different things. The other thing, if you really want to be terrified, so the average Facebook user had something, I want to say in this study, had like, let's say about 270 Facebook likes. So the average user is basically as accurate as your spouse. The challenge with this is that there's many other users that had more likes than average. You give the algorithm more information, it gets better. And so as you're going over that 270, 280 likes, the algorithm accuracy actually beats your spouse. I think that was interesting. You talk about like Peter Norvik's paper. This is a lot about what they've talked about, is that we do need to essentially change a little bit of our reference because the data sets have gotten so big. It used to be that, let's say an intuition and the human is still really, really important. It's not like you just take a pile of data and somehow insight comes out of that. You have to know what to feed into it, what to look for, what features, things like this. But lots of times, I would say historically, the really smart person, the domain knowledge, always beat the algorithm until you give it more data. And that's exactly what we're doing. And that's where things start to get so exciting in terms of, various different compute methods. Why is the cloud wonderful? The cloud is wonderful because you give people access to essentially cheap, unlimited compute, what you can do, different algorithms, different pieces of software code. And it's that more and more data has just made things better and better. And you can answer, quite frankly, really interesting or quasi-terrifying questions depending on how you look at it. If you haven't, anybody go to YouTube and you want to be really fun, is one of the different challenges they put out there on YouTube. You can watch, I think the last one I was looking at was Google, in terms of training an algorithm to play essentially different computer games and training the algorithm to do it at an expert level. The algorithm doesn't know what game it's playing. It learns over time. It takes 60 to about 200 rounds before it basically plays that computer game at an expert level. And that's all about, data and compute. And that's essentially, really what we're talking about here. So that'll turn it back over.
Yes. So Ryan, it's exciting, but where have you seen things go a little awry? Braxton talked about a big one, 400 million, but and what are the things that you look for when some of the scientists come to you and say, I've got this great new data set, but then it can be completely, giving the wrong type of signal, or they're misinterpreting it in the wrong way.
So I'll give a couple of concrete examples. So one of the first ones is that, we spend a lot of our time essentially you think of as teaching a computer to read, right? Why? There's just so many, our ability to produce kind of information far exceeds our ability to consume it. So you look at something and you've got we get about 7,000 broker reports a day. It's really, really difficult for, an individual to read 7,000 broker reports a day. But a computer can. Now, what do? Well, first you say, here's some good words, some bad words, feed them in, maybe count the good words versus bad words, other different things. You go on to different features. So what are a couple things we initially didn't do well there? So first, good is a good word. Increase is a good word. Turns out increase when it's by revenue is a good word. Increase when it's by cost is not. All right, it took us a couple years to figure that out. And that's a little bit of a cleanup. The other thing on something like a broker report, what's interesting about this, if anybody looks at a broker report, and if you don't come out with having some kind of knowledge in terms of about finance, is you see that most broker reports essentially have a page or two of text and 5 pages of disclaimers, right? And the challenge with that is that the disclaimers are really non-informative, and they're typically overly negative. And so if you're thinking about taking a broker report and processing all that text and not parsing out the disclaimer, you really screw it up. If you also go in and don't understand things that, in broker reports, is the kind of easy example is, you've got 20 brokers that follow the same firm. If there's a conference call or event at the firm, every broker is going to write the same thing. And so you only want to figure out who's got new information, and you have to build that in. So I think sometimes that domain knowledge is missing on different, and that's been one of the features. I think other things is that we can answer lots of interesting questions with data. Not every one of them are relevant for returns. So sometimes the most interesting question, what you can do with kind of Twitter data, things like this, you can do lots of fascinating things. Lots of those fascinating things don't necessarily predict returns. And I think lots of times that's a little bit, again, where you can be overly fascinated with the data source, the question. There's, fun things you can do with Twitter and learning about, fantasy sports predictions, things like that. There's a certain subset of that information that's actually interesting for macro trends and things like this, but you have to figure that out, and sometimes you get lost in there.
Look, I've got a ton more questions for the panel, but let's open it up to the floor and see what's out there. What's on everybody's mind? I think that was a great sort of tour of what's happening in big data to start with, but what's on everyone's mind here? Any questions?
This is slightly off topic, but the hot news is Apple versus FBI. And do you have any reaction on that? And from an economic perspective, is this really something that Apple should feel so strongly about? And my other thinking is the FBI is probably already in there, or the NSA has probably already cracked his phone, but I don't know if they're setting Tim up to be, I'm not a good guy, I'm not going to let others in, or what. I'd just love to hear your take on that.
I don't know, maybe I'll go first and that's it. I would say, like, the first thing, and this goes to Rashid's point of, Apple is just protecting essentially what its most valuable asset is, and that's data. I mean, you know, the amount of information that Apple has on you, things like this, and everybody used to talk about Microsoft as being the evil one. Like Apple, you know, like I think I've got 2 Apple computers, I've got 2 iPhones, and I've got like 3 iPads. They've got me nailed. But so I think you have to view it from that perspective. I think, you know, the perspective of, is the FBI there, is the NSA there? Sure, you know, probably. I mean, have you seen the size of the data center they're building? It's like, you know, they're getting data from someplace. It's going in there. So to think that someone's not watching it, the other side of, you know.
Well, that's what they were built for.
Yeah. You know, the amount of information you've already given away for free is, you know, literally like Pandora is a good example. They have everything on you, right? So I think that's, if you view it from you're protecting your most valuable asset, it's no different than like a patent dispute or things like that.
Well, I get that, but what about the national security side that, you know, another bomb can go off and kill a lot of people?
I'm sure. I mean, it's clearly a concern. But, you know, honestly, you know, I would just call it like reasonable. If you want to stay off the grid, you can stay off the grid. Like, you know, you're not going to stop the random jihadi who's just wandering, you know, around.
I would also just add that it's kind of raising a much larger issue that you're going to see kind of play out more and more over the years, which is the fact that privacy laws just haven't kept pace with technology. Ryan alluded to it in the fact that you have no idea when you're subscribing to Pandora that all this other data about you is being sold, right? That's just, you know, once that becomes a fact, journalistic mainstream, that's another, you know, real risk of kind of data, non-traditional data in your investment processes. A lot of these data sources are actually vulnerable to being shut down just when the privacy laws catch up with what's actually happening. I mean, imagine a point, just to give you a hypothetical to think about, suppose all of the data on your phones, your Facebook likes, et cetera, were unlocked, and you have these algorithms that can predict you better than your wife, you know, and they get to a point of 80% accuracy that you're going to commit a certain crime, but you haven't yet, ought you be locked up for high probability of committing a crime, right? Because, you know, your actions are predictable, but there's a certain irreducible human feature of choice, right, where you can go against the probabilities. And balancing that, I think, is a really interesting, you know, philosophical question.
I would say I feel like Apple is doing this for its brand. You know, I think people, you know, they want to be viewed as people who will safeguard their data. I think the thing that's funny is most Americans really don't care about privacy. Like, you can get encrypted email. It doesn't take that much effort for you to encrypt every message you send in a way that, you know, even if the NSA were inside your phone, they couldn't read it. But nobody actually appears to care or do that, even though that option is completely available to you. I mean, the idea that the NSA is going to break our ability to do encryption is kind of laughable because you can encrypt any message you want with a pen and paper, right? It's just mathematics. Like, they can't break math. They can just break the tools that you use, and consumers can choose to pick other tools. So there's this kind of weird thing going on where the reason that the NSA could get into everything is because Americans actually don't really care about security, and they're willing to take these mass market products that might have been compromised. And to your point that this changes behavior, you know, I mean, I think that if we did start to see some more pernicious effects, right, people getting, you know, I mean, I guess some of the things that you do see coming out of Facebook is like Facebook can figure out if you're gay based on what you do, right? So then people have been, you know, outed by algorithms, and then Facebook is trying to figure out how not to have that happen. If this became a larger problem, I think people would start paying more attention to it. But as it currently stands, like the average 20-year-old right now, like has everything about them completely visible to everybody at all times as a part of their natural lifestyle. So I think there's like a tiny sliver of people that care about this, and Apple is just trying to put a brand stake down, saying like, look, we're good guys, we're not going to let this happen. But I think we're very far away from anybody actually practically, being willing to make consumer choices based on that.
Other thoughts, questions? Okay.
Well, kind of along this theme of maybe counterintelligence, but just in terms of big data, are people using it in kind of a, I don't want to say counterproductive way, but kind of fighting back in the sense that, early on people realized that when there's insider purchases that it's an important signal, and then I think a lot of senior executives learned that, so they buy stock even if they didn't really have a lot of faith in the firm because they knew it would send a signal to the market. Are people using the software to kind of analyze their press releases and say, well, this is actually how it's going to be interpreted, so I should manipulate it? Or, almost plant certain pieces of data out there because they know it's going to have an knock-on effect. And again, there's not so much big data that's being used, maybe perhaps intelligently now that could move markets, but I'm just wondering then this kind of next level in terms of people using it in a kind of a countering way.
Yeah. So we've, yes. A nice example of that is, again, I go back to conference calls. When conference calls initially started, much more interactive and free form. Now, the prepared remarks in a conference call are typically pre-recorded, and they've been scrubbed of everything kind of interesting. What that means, though, is that the second piece becomes more interesting a little bit. And so, like, looking at something like the Q&A, no offense to our CEO, but, like, listening to the CEO in a conference call, not typically all that interesting. The other players are more interesting. Why? A lot of that is, like, they've had plenty of press training. They've had all these different things. They know what they can say and they can't. And so we've seen that behavior shift over time. You've also seen things like the other side of it is that the almost like explosion in channels. It used to be like anybody who's an investor in Tesla and is not following Elon Musk's Twitter feed is missing out. Like, that's how he likes to release information. For better or worse. Sometimes he likes to throw things out there just for, fun, and that pops the stock price, and then it goes back down, and people are like, oh, that didn't happen, like a spoofing feature. But so it has changed it.
Other thoughts?
I would just add one point on that one. So I think it's kind of hard to really gamify or to game the system if you're a single individual because there's so much information being collected. I think the larger problem is that these systems are big feedback loops, right? So people are building these products that price things based on all of this data, and then everybody's reacting to that information. So like take Waze, which is that app that like routes traffic and it'll tell you which is the best way to get where you're going based on the traffic. If only one person has Waze, it's like perfect because there's like the one traffic route that's really crowded and everyone, you get around it. If everyone has Waze, then suddenly the system actually floods all the other avenues. And I think this is the real danger of these sort of like giant systems that collect information and then feed it back to everybody, is that suddenly everybody's changing their behavior simultaneously based on and that kind of creates a snowball effect. I think you actually mentioned this on our conference call, right? But like Google had that thing that would predict whether there was flu based off of Google searches, and it was really accurate, right? If you would type in flu, then they could figure out like there was flu in this area because all the people in that. But as soon as everybody heard that that's what Google was doing, they all went to Google and typed flu, and so then Google thought everybody had the flu. I think that this is actually one of the biggest problems for this kind of technology, right? You calibrate these giant models based on the data that you observed in the past when none of these systems existed, and you put it out there, and everybody changes their behavior, and suddenly the model is completely wrong, and you could get a snowball effect. And I think that makes it actually really challenging to derive signal for investment purposes, because the signals that we're getting about market pricing over the last year are actually informed by this technology, and 10 years ago weren't, and every year it's changing. I'm sure you've seen a lot of that.
One individual, though, had the ability, though, to kind of populate a lot of requests for flu from seemingly random sources. sources, could that then have that type of effect, or that type of market manipulation?
People certainly try and game that, and if you've seen some of the controversy around Bitcoin recently, that's actually been driven a lot by the fact that there's a relatively small number of players have some enormous amount of capacity on the system, and they can choose to behave in a different way to game the system, right? So, like, I think that's because that's still a relatively small ecosystem. As these things get better, it's harder and harder for one individual to have that kind of outsized capacity, but it's certainly a risk.
Good question. Yeah.
This question is probably most for Braxton, but any of you can please weigh in. Braxton, you talked a lot about the engineering culture that's being built in certain hedge funds. Mm-hmm. If you look to the long-only world, what do you see on one side?
I think it goes back to Rashid's point of fundamentals investing, right? So, like, you can do this work to try and build an engineering culture around mirroring macroeconomic data to predict prices, like short-term price movements, right? So, like, if like, I know the guys at 2 Sigma well, and they're obviously masters of this process, and they've invested huge amounts of money. They have like 800 engineers on that kind of problem, but they're obviously not long only, right? They're pushing everything around. But the ultimate value of this technology is that it actually should be able to figure out true facts about the world that you can use to allocate capital to good companies who are undertaking projects that deserve to be funded, right? I kind of think that that's the actual, from our like society's perspective, the biggest value that this kind of technology can bring, that it can actually identify real fundamental mispricing. So I just think that it takes longer for people to capture the value out of that, because you actually have to make an investment and wait and see if it worked out, as opposed to just waiting to see if the price corrects tomorrow. But, like, I do work outside of financial services as well, and like, applications of this kind of technology, for instance, for medical purposes, to actually tell you if someone's sick. Like, I saw there's a guy doing an awesome use case where he's using image recognition technology to predict if someone has tuberculosis from an X-ray. That's the kind of thing that in the developing world could have a massive impact on a very fundamental level for the health of a huge number of people. Like, that's clearly better for our society over the long haul than say, showing me a better advertisement or something like that, which, like, obviously drives short-term value for people. And so, it's hard to make generalizations. I do think over the long run that world is going to benefit some of the most, right? It takes longer.
So. Just follow up before the others weigh in, but that would suggest that the much larger firms who have the resources and the capital to invest in the engineering culture would be better situated than some of the smaller firms.
I think that's right. I mean, I think that the cloud computing stuff can level the playing field, right? So 3 or 4 engineers who actually know how to use cloud computing well can do the work of 100 people inside of a giant bank, because working inside of one of these larger organizations, if you have the wrong culture in place, can be really hard. I think that the fact that the tech giants are open sourcing so much of their infrastructure lets all the other players catch up and stay relevant. If you had to build all this technology from scratch, you really would need the 500 or Google has tens of thousands of engineers, and they build everything internally. That having been said, I've definitely seen, like, the places that have bought onto the engineering culture the most, they have a lot of engineers, and they're really doubling down on it, right? I mean, like, as I said before, 2 Sigma's got like 800 engineers. I mean, they're spending, $100 million, some giant number on people every year. I just think that that's in part because companies like that are also trying to invest across a huge number of asset classes. So if you get at the point Rashid was making, right, like, when you do this work to try and make a fundamentals bet, it's just affecting a couple of companies. People who are doing this systematically are repeatedly doing that analysis across a huge number of different data sets and different channels, and trying to aggregate that into a giant view of everything across the whole economy, and that's really labor intensive. So I think the smaller funds, they just end up doing this on, if you have 3 people, you're going to do this on 1 or 2 data sets, and the total P&L that you can produce out of that is going to be limited to what you can extract from the assets that you can trade based on that strategy.
So I would add one thing on the long-only question. So I think you first have to look at basically what's going on in the long-only space. in terms of asset flows, fees, things like this, and fee pressure. There's not a lot of people out there that are really making big investments. The other side of it, though, too, is like, and I think Braxton made this, or this isn't like a party of one game. You actually do need a team of people in place, things like that. And so, I mean, it took us, almost 7-8 years to get to where we are with this, and having kind of really about 100 of us kind of doing a lot of this type of work. It's really difficult to change a culture at a big bank shop when you go in. I mean, the first time we asked BlackRock for 50 terabytes of storage and said we're going to need another 50 terabytes tomorrow and things like this, like some heads exploded in certain places, right? And we got over it. The second time we went to HR and tried to hire someone and said, look, here's this, really, we're competing with like Google, Facebook, Two Sigma, D, Shaw, and Renaissance for this guy, and he wants Uber credits, some TaskRabbits, things like that. Like, it's part of his offer. Like, again, like corporate HR's head kind of explodes. They're like, what are Uber credits? And you're like, honestly, you need Uber credits and TaskRabbits and things like this to hire some of these people. And so it is, either having people there to begin with that understand this, that like this is the game, I think is really quite challenging. And then, to the point, some of the smaller places, they're just not, they're more nimble. They can do things. I think we've benefited a lot, quite frankly, at BlackRock from one of the founders, really, Charlie Halleck. Just, his son's a PhD student at Stanford. So he gets it, and that was really, influential for us. It also helped that his son's PhD advisor is on our advisory board, so, that worked too. But
I think there was another question here.
So, very appealing to think about how big data can be applied. And the advantages are almost, they're easy to expound, and you did a great job. And you described, I would say, 2 approaches to using the data. One is sort of an expert knowledge, where you presume initially a theory, whether it's LinkedIn job openings or the delta on that, how that opines a payroll report, starts with an expert knowledge theory about payroll. The other side was the Google Translate approach, where you let the data opine the opinion. And it's funny, that's very much like a macro trader's reliance on all information is represented in the price, and Google is saying all information that I need is in the data. Well, that's great. There are disadvantages to both, and so as people in this room go meet other managers or whomever who are going to bandy about the phrase big data, it is trending. What cautionary words would you send out to the room to say, hey, it's going to be easy to hear this thing, but what should we be watching out for?
One thing that I would say, and I'm sure Ryan's going to have an opinion on this, Braxton probably also, is that one red flag that I see a lot is when people put a lot of stock into the actual analytical techniques that are used in the big data discussion. So I see a lot of people talk about machine learning techniques and extracting information from the data through those techniques. I think that there's a little bit of value that you can have from a slightly more sophisticated technique, but really I think that the people who are serious about the data revolution are focused on the inputs, not how those inputs are processed in some particularly special way. So I would say that if you're talking to someone who says that, well, I'm looking at price history, which everyone else is looking at, but I'm using a fancy machine learning algorithm to get some knowledge out of it that other people aren't. To me, that's a sell that requires much deeper diligence than someone who's saying, hey, I've embraced the data revolution not through specific analytical techniques, but through just a broad range of inputs. And here's A, B, C, D that I'm looking at that is just a fact that a lot of people aren't looking at. So I would say that distinction between the input versus the analytics is a really key one to look out for allocators.
So to me, the first red flag is how your people talking about big data like real. In the sense of if it's a guy who's been a portfolio manager for 20 years and has an MBA from such and such a place, like I would say in general, like he's probably not my pick. Do they actually have proper kind of computer science background? So not that everyone there needs it, but you need a mix, because it is that kind of domain knowledge and actually having people that do, proper engineers and things like that there. That, to me, is always like the first flag. I think the other red flag is like what I would call is like the unreasonable belief in the effectiveness of big data. If like big data is the solution to all your problems, and I would say again that's kind of a red flag. It's not like we just somehow magically the data gets insights and things like that, or gives some wonderful insight. And ultimately, I think probably the last thing I would say is what's always interesting to me is to know like what their future plans are. What is it? Because if your big data game is Google Trends today, I'm not sure that you're really kind of keeping up or things like that. What are you investing in? Where are you seeing? Because it's changing fast, and it's moving into. I think you have to plan for it. If you think this is going to be an edge, you need to be making a plan like where you're going to be 1, 2, 3, 5 years from now.
One more.
Just maybe a little bit derivative question. I happen to have a young man in college, and so partly from his point of view, we were talking about this before, it appears we have a huge gap in the number of people that are available in the workforce to come into these roles. Who won't particularly come out of computer engineering, says McKinsey. It's a different breed. What's the academy doing in reaction to that?
So first, interesting, I would say, because we've got Stephen Boyd and Rob Tibshirani who are on our advisory board. If you want to have your mind blown, 90% of the undergrads at Harvard signed up for Stephen's course, which is introductory, like machine learning, not at Stanford. And so you sit there and you think about, at Stanford, we're in the Bay Area, things like that. But just to think how much of even English undergrads, right, are, taking machine learning courses. So you are kind of seeing it. But, lots of different things, and looking around, and I forget what is the McKinsey book of the year this year, where it starts off in this book, I can't remember the name, where basically you get this reasonably written kind of odd sporting article. You're like, wow, it's a really weird thing. And 3 pages later, it tells you it was written by a computer. And so when you think about some of these things about what are we doing as a society, there are some issues. We had another we're talking with the CFO and one of the CEOs for a large manufacturing firm. What a lot of people don't realize is what a lot of artificial intelligence has done is basically allowed many machines to learn. It used to be you bought a robot and that robot could do one task and that was it. But now robots can observe and they can learn and they can do multiple tasks. So you're where are you putting your factories? So I'm putting them in Germany. You're well, isn't labor really expensive? And he's I don't need labor. I need engineers. And so when you think about lots of those things, if you want to think of universities, things there are big kind of structural issues about, be it automation, be it, other fun things, even simple things like insurance claims. With the proper kind of algorithms and stuff and things there, basically now one claims guy in an algorithm to do the job of what used to be 1,000. That's got but in general, I would say education hasn't really kept up.
I would just add, so the 2011 McKinsey study you're referring to, which is the 400,000 shortage of 400,000 data scientists, right, or from now to 2018. I think it makes sense. I think that the academy is definitely responding. You see, I think 2 years ago there was maybe one data science master's program in the country. Now there's there's dozens now. Moreover, kind of what I would call the underground academy. With data science, boot camps, Coursera, all these online courses, a very famous one, the Stanford Machine Learning course online. There's, again, as an advisor to this kind of recruiting 2.0 company that's focused on that particular vertical, I can see that society and these other kind of more underground academic institutions in the boot camps and the online courses are definitely responding to this, this kind of demand very aggressively. So it's not something where I see in a few years there's going to be a real shortfall.
Phil, did you have one?
It was actually the
Same question. Okay.
I had one thought to add on that. So I feel like in part right now the reason there's such a shortage is that it's actually still really hard to do anything with these data sets because you have you need people who have both a combination of statistical thinking, like they can think economically and avoid the pitfalls of just believing whatever it is that the data tells them, but they also have to have the computer science and engineering wherewithal to be able to write programs that can handle this stuff. And so there's not a lot of people that have both of those skill sets, and it's incredibly hard to train people in both of those things. And there's this idea that we're going to teach everybody to code, but it's I think it's a little unrealistic to expect every human being to want to sit in front of a computer 12 hours a day for 15 years, which is how long it takes to get really good at this stuff. Not everybody has that inclination. But I think that over the next 5 or 10 years, I think the technologies that we use to do this stuff are going to mature. Right, like I've seen firsthand in my work how much better it's gotten in the last 5 years, and I think that's going to buy down the cost a little bit. Right, you'll be able to have people who have less of the engineering skill set and more of the statistical skill set actually get involved and be productive. Most of my work as a computer scientist is focused on exactly that problem. How do we make it possible to not need to be good in both disciplines? And so I think if you look forward, that's another place where a broader group of people is going to be able to play effectively in the space. So.
Great. Thank you. I'll hand it back to Steve.
Thanks, Brian. As the resident historian here, I just have to make a couple of comments. 1999, we had Gary Wendt here, and he talked about human capital is not being properly valued on the balance sheets, and the LA Lakers put their players on the balance sheets, but human capital. It's interesting that you've just called out something that big data is not an asset that's not being properly valued. So that struck me. Also, Spencer's comment as the historian here. So Spencer's comment, Spencer, if I could paraphrase you, does big data give us any variant perception in that? So Peter Bernstein, before he died, he came here on the session on contrarian investing, and he came out with the comment that the crowd is usually right, that the thing is reflected in price. It's only like 5% of the time that the crowd is not right. So as we're sampling the crowd and getting big data from the crowd, has that changed? Maybe it has, maybe it hasn't. But that was an interesting perception, and the wisdom of crowds. So I'll just leave you with those two thoughts. I don't have any other housekeeping things. We're going to take March off. Our next time we'll meet here is April 21st on the subject of volatility, speakers information, and that is about it. Connie, is there any other? That's it? So, oh, yeah, that's right. Excuse me. And if you would let our speakers know how they did and fill out the comment cards. And Brian, thank you very, very much. Very good job. Good session.
Thank you.